Okay, hello accounting class. This is Mrs. Lamphere, and in this video we are looking at assignment 4, recording transactions in a general journal. So this first tab is just instructions, going over part 1 specifically, but the same thing will apply to part 2 as well. So we're working for Rex Consulting Services, and they opened business in January 2005. The company maintains the following ledger accounts. So these are the different accounts that we're going to be working with in part 1, and then in part 2 you're going to notice that they add on a couple more accounts, and then they're going to give you a list of transactions that we're going to have to go through and analyze and record and pass the journal entry. So make sure before you complete this assignment that you've either read or watched the videos over Unit 4 Section 1 and 2 about information regarding journal entries. So that's what we're going to do. We're going to analyze and identify the accounts that each of these transactions affects, so which we've done in previous assignments. We're going to classify those accounts, whether they're asset, liability, owner's equity, revenue, expense, or withdrawal. Apply the debit and credit rules, create a T account, and then pass the journal entry. So these first 4 steps are all kind of part of the analyzing the transaction process, and then once we've analyzed it, we pass the journal entry. So let's take a look at part 1. And I'll zoom in a little bit on this. So again, here's our list of accounts that we have to choose from, the different account names we're going to be working with. Rex Consulting Services opened for business January 2005. The company had the following transactions. So on January 15th, Rex invested capital of $50,000. So this steps 1, 2, 3 kind of walk us through the process of analyzing this transaction, which accounts are going to be affected and how. So you can either type them in here or just go ahead and start filling out these T accounts. So with this very first transaction, just like in every other assignment when we've had a first transaction into starting a business, we know that investment into the business of $50,000 is going to affect our cash and our capital account. In this example, or in this exercise, our capital account is called capital stock. So we're going to work with account number 1.1, cash account, and then account number 3.1, capital stock. So I'm going to put those account names down here. Cash account and capital stock. And we need to indicate whether this debit side increases or decreases. And as an asset account, you should know by now, and make sure you're using your reference guide if you're not sure. But as an asset account, we increase on the debit side, decrease on the credit side. So I'm going to put my plus sign here, my minus sign here. I just like to center those up. All right, and then for a capital account, we know that. And I guess we should up here. So you need to indicate somewhere, and it could either be right above the account names, or you could do it underneath step 2. But we need to indicate that this is an asset account, and capital stock is an owner's equity account. So looking at our reference guide, we see that as an asset account, cash is going to increase on the debit side, decrease on the credit side. And as an owner's equity account, capital stock is going to decrease on the debit side, increase on the credit side. So we're going to put our decrease sign here and our increase sign here. And then the third row is the actual amount. We have $50,000 that we are going to increase with cash. So we're going to debit our cash account for $50,000. And we're also increasing the value of our company through stock, or in our capital account, which is a credit to capital stock. Okay, then you'll notice step 4, we're actually going to pass the journal entry. So now we go over, this is our general journal over here. And so for our journal entry, just like we did in the examples in the videos, this would be January account name. We always want to list our debit transaction first. So we're going to put in cash account here. We debited that account for $50,000. And then we have capital stock, and we credited that account for $50,000. One debit, one credit for one each transaction. So this is one transaction in our general journal. Okay, so this is like kind of the actual accounting process, was recording these transactions in a journal. All of these steps, eventually we're going to get to the point you're just doing this in your head. Right now we go through all these steps just to kind of still get you familiar with analyzing the transaction, but then when it comes to actually recording the transaction, we simply pass the journal entry, which is what we just did. So let's do one more together in part one. January 17th, we paid $400 of office rent for the remainder of January. So we have up here in we're paying our rent in this transaction. So obviously rent expense should be affected, and since we're paying our rent, that's going to be coming out of our cash account. So whether we're writing a check or paying $400 cash, that comes out of our cash account. Okay, not accounts payable, because it doesn't say that we're paying, that we're making a payment in the future or anything. We're paying this right now. So what types of accounts are affected? We're going to be affecting our cash account, and we decided rent expense. And again, our cash account should be set up just like this one up here. So I'm going to copy and paste it down here. So we're increasing debit, decreasing credit in the amount of, oops, oh, and I'm doing this on the wrong, sorry about that. There you go. Okay, the amount of $400, so we're spending money, we're taking it out of cash and putting it towards rent. So we're crediting our cash account by $400, and as an expense account, you'll notice an expense account increases on the debit side, decreases on the credit side. So we're increase on the debit, decreasing on the credit. All right, and so I already have my credit, and so since I know I need a credit, a debit, and a credit for each transaction. Here's my credit, so obviously this one's going to be a debit. And again, this is where a lot of students get confused. Is we're paying rent, so they want to decrease our rent expense account, but you need to think of it as we're putting money towards our rent. So we're increasing the amount of money we're putting towards the cost of rent. Okay, so here's my debit, or here's my debit, here's my credit. So let's make that journal entry. And remember, we always want to list our debit first. So we go up to our journal entry, and this is on January 17th. We're debiting our rent expense account for $400. And we're crediting our cash account for $400. Okay, so by the time you're done recording the remainder of these transactions, and I just copied and pasted that chart down here one more time, that way you don't have to scroll all the way back up. But we're doing the whole month of January. So one way to double check yourself that you've done everything correctly is to total up your debits and credits. So your total debit column plus your total credit column should be equal. That's one way we know, or we can kind of double check on our transactions to make sure we did them all correctly. In part two, same kind of thing, only we're adding in some revenue, a revenue and a withdrawals account. Okay, so exact same type of thing though. You analyze the transaction, you record the journal entry. Oh, and there is one more step. So in part two, they've added in their source document information. So let's look at this first one together. January 5th, Mr. David took $20,000 from personal savings and deposited to start a business. So this is a new business that we're working for. Mr. David started his business with $20,000. So same kind of setup. Actually, let's double check where his cash account is just called cash account. And then he has David's capital. So we have cash account, David's capital. And again, we should be determining what types of accounts these are. This is an asset. This is an owner's equity. Cash account, we know increases on the debit side, decreases on the credit side. Opposite for the capital account. Okay, the amount is $20,000, so we're putting $20,000 towards the business from our personal savings. So it's increasing the amount of cash our business has and increasing the amount of capital. And this was all recorded on memo number 1. So that's our source document that we talked about in the lesson from this unit. So that also gets recorded into our journal entry. So now we make the journal entry for this transaction. So January 5th, always listing the debit first, cash account, debit in the amount of $20,000. David's capital is our credit, amount of $20,000. And on this third line is where we want to list our source document information. So this was all recorded on memo number 1. Okay, so that way if we ever need to go back and check our sources, if maybe we're getting audited, we need proof of all these transactions, right? And so that's what that memo is for. And so that is, again, the rest of these transactions, same thing, analyze the transaction, set up the T accounts, pass the journal entry. And make sure then also, like on number 2, your source document is going to be the check number. So check number 506 would be your source document for that transaction. Memorandum 5 is your source document for this transaction. Check number 507. So that's the only difference between parts 1 and part 2, is you have your source documents that you also need to record in part 2.